Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to rip through Twitter or X and see what people are talking about, see what news is out there. I'll give you my financial opinions of what's going on. And again, if you want to follow me on Twitter, it is at finding_finance. And you can also join our community at finding-value.com. We still have that 50% coupon code going on off the first month if you want to try it. The coupon code is September if you want to join. And don't forget, we do have a 5 p.m. Mountain Standard Time Sunday question and answer session coming up. So Eric says, don't fret the short-term inaction of energy stocks to the rising oil price. What I care about is free cash flow. Stock action will eventually reflect the record amount of free cash flow being generated, especially with final debt targets being hit in the coming months, leading to much more meaningful share buybacks. So just be patient, guys. I know a lot of people are looking at the stock prices and saying, oh, this is going down. I should get afraid. The price is still high. It's going to generate cash flow. Cash flow generates earnings. Earnings generate higher earnings per share. And eventually, the money will wake up and come back around and start investing in it. Oil stocks, that is, again. So be patient. We've got a little bit of a pullback, but cash flow is robust. We've got the 30-year bond monthly price chart. Looks pretty darn broken to me. And this is bond prices. This thing is just falling off a cliff. Interest rates rising means that bond prices are falling. We had nice, good support. You can see the volume over here, generally at this general area, but that just broke down and it just started flinging it to the downside. There's people talking about much higher interest rates ahead of us. There's a debate. Some people say we can't have interest rates that high, it bankrupts the government. Some people say, look, everyone's dumping bonds. There's no way out of this without higher yields because no one is buying bonds and they're releasing trillions of dollars of worth of bonds. So again, to me, looking at the charts and what I see in the charts suggests higher yields, which means lower bond prices. So this is going to go down and could continue lower. This is the yields I was talking about. Yields for the 10-year and 30-year. They're going for it. They're breaking out to the upside at this time. Is this going to be a false breakout? And you know what? I don't know. I don't know that answer until we get a stronger closing on a longer, a weekly and monthly time frame. So we're breaking out to the upside. I just don't know how sustaining it will be until we really close and validate that we are breaking that to the upside. Cuppy says you can solve climate change by buying our crappy collapsing bonds. Yeah, you could. He's got a lot of posts with "This is Africa" or an emerging market where our yields are going to continue to go up and we have a debt problem, and that our yields will continue to go up, bond prices down, and inflation will remain elevated. Bob says, real money and retail investors are all in overweight tech and meaningfully underweight energy. Elevated tech valuations, rising long-end yields, and rising oil prices are setting up this positioning for a squeeze. And what I think is going to happen is we're going to get tech to flow, that money to flow out of tech because of the rising long-end yields. And then we're going to see oil prices go up and the money is going to start to position in energy and probably get a squeeze over in energy. So that's, I think, his statement and my guess as well. We've got Jamie here. He says, regardless of the initial bullish reaction to the Fed's announcement, don't be surprised by the smackdown in the paper price of gold at the COMEX. For a long time now, the algos have never allowed the paper price to rise higher than the price it was prior to any Fed announcement until the week after. They don't want Western investors to figure out it is not a pet rock. They will have to figure that out on their own at a very expensive cost. However, true price discovery is afoot and continues moving east at the Shanghai gold opened higher and currently trading at 2015 as Asian demand for real money continues strong across the region. So what's happening here is we're smacking it down here in the COMEX. The East is bidding it up, and money is going to, I should say money, gold is going to go from the west to the east, and it's going to stockpile on at the east. And that's what's going to happen over time. They're going to lose control of this market, and I think gold and silver are they're going to rocket at some point. Just a matter of time. Here's Seabridge Gold Investor. He says, if gold buys more energy in China than in the West, then gold will flow to China until either the Western gold price rises or the Western gold vaults empty. Russia's recent announcement it will sell gas to China for gold at half the price of Europe beginning in January of 2024 will all else equal accelerate the walk on London gold already underway, as it represents an even higher gold to oil ratio in China than in the West. As Mr. Groman states, China, Russia have weaponized gold to counter the weaponized dollar. As the world financial system bifurcates and goes onto war footing, we see the beginnings of a battle of the fiat dollar versus gold. That is pretty profound to be stating that stuff. And honestly, guys, I'm curious to see how this all ends. I think gold is going to be a lot stronger than a fiat currency. Someone says the Case-Shiller housing, or this is Uselink, the Case-Shiller housing is at all-time highs. But, hold on. Versus the M2 money supply, we are way below 2008 levels. So this is the US Shiller doing that double top. This is the M2. Look at how different that picture is painted when you take into account how much money is in the system. This looks like it's breaking a basing pattern to the upside where the home price index, Case-Shiller home price index, has a long way to run up in relationship to how much money's been created. Who is right here? I don't know. Time will tell them. Eric Nuttall, allow me to reiterate, we do not need a higher oil price for oil companies, energy stocks to do very well. Inevitably, I believe, aided by lower volatility, seeing will equal believing. And there's a lot of companies and their free cash flow yields way greater than 18% on the left-hand side here. Now, there's some high-cost producers on the right that I think are opportunities for investment. As prices are low right now, and they will go up, especially in natural gas. There's some really good spots on the right-hand side over here in natural gas companies for potential investments. Uranium, it says, Old Turkey's famous response was, well, this is a bull market, you know? From reminiscences of a stock operator about Jesse Livermore. It says, no corrections, only buying opportunities. It's a bull market. Uranium, good luck and Godspeed, friends. What you want to do in a bull market is accumulate on the pullbacks. And what you have to keep in mind is, well, this is a bull market, you know? You don't try to time in and out in a bull market. You just accumulate, you buy the dips and the pullbacks. That's my strategy. It's taught in the reminiscences of a stock operator. They talk about this and how to accumulate and hold through a bull market, and that not many people can do that. They don't have the wherewithal to sit in a bull market and just sit and do nothing. Tavi says, since the 1900s, we had 4 notable commodity cycles. 3 of them occurred during inflationary periods, the 10s, the 40s, and the 70s. The 4th cycle took place in the early 2000s, coinciding with China's entry into the World Trade Organization and its emergence as the manufacturing hub of global economy, leading to one of the most extensive construction booms in history. Now we stand on the cusp of witnessing these 2 macro tailwinds at once. The onset of another long-term inflationary era, a global manufacturing revamp, particularly from G7 economies to reduce reliance on authoritarian regimes. Another commodity cycle is underway. What a great chart from my friend Ronnie Stoferle. And there we go with this big boom that is underway in commodity prices. Commodity boom, pullback, commodity boom, pullback. You can see the cycle, and we're in another commodity boom. I had premature ebraculation here. I said gold's about to break out, ready for the launch. We were about to break there. The news came out from Powell and just romped it. It romped gold lower. I'm sure there's a lot of manipulation going on here. Guaranteed. I still think that we are going to recuperate ourselves down here and work our way on up again, because the natural tendency of gold, silver, and platinum under these market conditions is to bubble higher. It's not to go lower. And that's why all these charts are signaling that. We've got aluminum. I said aluminum's looking ripe here. You can see it there. If you zoom in on the right-hand side, it's breaking out to the upside. So aluminum is looking pretty good from a long, big picture view. We've got today's bond market hinges on three assumptions: a negative term premium, low inflation, and a stagnant neutral rate. Yet, from a chart perspective, it seems obvious that the secular bull market for bonds ended in 2020. That puts all the assumptions to the test. And we can see the nice big move higher in yields on the US long bond. We've got silver. This is the bigger picture all the way back in the 1970s. We've got the largest cup and handle formation that we've ever seen of any chart ever. What does that mean? It means that silver is a great opportunity, and we could see a monster move in silver to the upside. Now, I'm curious here, guys, because let's just chart this real quick. He used silver from Owanda. So silver, hopefully I can yank this up. There it is, silver. We go to the big picture view here. Let's go throw it on logarithmic. I'm just curious. So here's the big picture view. We can throw this is the cup and the cup and the handle. I'm going to take the bottom of this to the top and put a price projection on this. Oops, I was going to grab it. There we go. We're going to put a price projection if this breaks to the upside. The price projection is $466 on a logarithmic scale of silver if it were to break out of this. So I know a lot of people say, oh, silver, it's going to go to $100. I don't think so, guys. You don't break a 40-plus year pattern and have it only go up to $100. I would say that's almost impossible. I do think that something like $250, $300, $400, $500, $600, $700 is possible in silver. Why is that possible? I don't know what's coming for the market conditions, but it's going to be highly inflationary is my guess. People could get scared. The supply side could not keep up with demand, perhaps, and people run at gold and silver. This is what the chart is suggesting, and this is the potential possibility of where this could potentially go based off of the chart. So when we look at this and when people make these claims, about, Uselink, myself, other people that are looking this, Gary that I had brought on, we're seeing the size of this pattern and just in straight awe of it. It's such a big pattern. It happens so rarely in time. Another thing that you can do, and we could project it another way, is you take the lead-in up to it. So let's start it at about 72. We take the lead in, and that we could have a potential continuation. If that was a continuation, this is calling for $1,366 silver. Is that going to happen? I have no idea, guys. That's not my projection. But the way that you project some of this stuff, it's like, my Lord, could this potentially go to something like $400 to $1,000 an ounce? Yes, it could. Now, am I projecting that? No, I'm not projecting that. I know some people get it confused where I'll say this is a possibility. That does not mean it's my projection. What I'm just telling you guys is it's possible that that could happen. And there's all these ratios in history that I can go over and show you things where the ratios project $1,000 uranium, $1,400 uranium, depending on where gold is priced at. And that is just the ratios basically going to what they've done in history. In history, one could argue that uranium was plentiful in the 1970s, and it was the threat of a deficit in the 2000s. Now we have legit deficits, and one could argue that this is going to set up to some ridiculous squeeze. So again, I don't know where the metal is going to go, whether it's uranium or silver. All I can tell you is this, guys. We are sitting on the largest patterns that we've ever seen in a lot of these markets. This is the largest pattern we've ever seen in probably any metal market in history. And to not bet on this going up, I think it's you're missing something in your portfolio. That's what I'll say. So, I mean, and I know other people say, well, what about platinum? Platinum's cheap to silver. I agree, it is. It's very cheap to silver. Did you know that platinum in the hyperinflation against Germany was priced against gold 5.5 times more expensive? Now, if that were to repeat, we could see silver do something crazy and we could see platinum do something crazy. I own both of the metals, and I'm not trying to sell you guys on anything. But to own some of these metals at what I would consider to be the cheapest prices against other assets, in addition to having patterns the size of this, guys, this is like cheating. This is like looking at the back of the book and saying, what the heck am I doing? I'm going to get some silver in my portfolio. Of course I'm going to do that. Now, that's not advice. It's nothing like that. I'm just telling you from my perspective and what I'm doing. This seems pretty dang obvious to a very long-term investor that we could get a breakout above $30 or $40. That's the yearly closing that we need. That could happen this year. And if it happens this year, who knows where we're going? And it could happen very quickly. Here's DNN versus CCJ. You have not seen anything yet. Parties just to get hotter or just about to start is what John's saying. And what he's doing is he's looking at the ratio here, and he's just saying these were some bottom times. These are some good areas to accumulate. DNN, or Denison Mines. Obviously, this applies to other uranium companies as well. But CCJ's taken off. And what this is signaling is that we've got some laggards still in the mix that have very good buying opportunities in uranium. Another great chart by my buddy Tavi. His last piece on the 60-40 portfolio is a must read. First gold cycle, second gold cycle, and we're about to enter a third gold cycle. Another thing that you could look at if you fine-tooth comb through all the data, we have a decline in supply coming. Every single one of these eras had a decline in supply of gold. Then it increased during these pullbacks. We have another falling gold production coming up ahead of us. We've got central banks that are accumulating gold, government debt at historical levels, unsustainably high fiscal deficits, a gold to S&P 500 near all-time lows, G7 economies entering a manufacturing revitalization era, rising deglobalization trends, the onset of an inflationary regime, 60-40s looking for haven alternatives, lack of new gold discoveries, ultra-capital conservatism by major miners, a trifecta of macro imbalances, debt problem of the 1940s, inflation issues of the 1970s, and asset valuation imbalances of the 20s and the 90s. Guys, wake up. This is a layup with the risk that you can take in some of these metals. The metals, if you were to look at it from the Exner's pyramid, On the bottom of the pyramid for risk is precious metals. Your lowest risk investments right now have gigantic upside opportunities. Why take the risk with the majority of your money? Why take it? You don't have to. All of these conditions are prime for gold and silver and platinum and all these different metals, in my opinion, to move ludicrously higher. Now, people are going to say, well, it hasn't moved in the past 5 years. I think that's the stupidest, stinking approach to have. Platinum hasn't gone up for 10 plus years. That's the reason we're in it. Duh! Come on, guys. We're in this stuff because it is so undervalued in relationship to other assets. The reason we're in it is because it hasn't gone up for 10 or 15 years. The reason I don't want to be in technology stocks is because they have risen for 10 or 15 years and all the money is located in that location. It's to be an investor, you have to do opposite of everyone else and buy the undervaluation asset. These guys are telling you where the undervaluation is, and then they describe the market conditions of why this is going to change. That's the whole point of being in these locations where you've got this dislocation of value in the market. And the conditions are changing for that valuation of these assets to change against the other assets. We've got silver in the short-term time frame. It was putting in an inverted head and shoulders. It was rocketing higher. Then it got smashed lower from the paper manipulators when the Fed came out. I can't see that this is more blatantly obvious. This is going to move up. Give it some time. Relax. It's gonna rip at some point. Saudi oil output down. Oil prices up. Here's the real war being waged on oil, folks, coming from the Saudis. So Saudi crude and refined product exports were at about 7 million barrels per day in July versus about 8 in June. There's your 2023 exports really diving lower here for oil. Ronnie says, don't buy gold, own gold. When you buy something, it's usually a trade. When you own something, it's a very different mindset. And we are entering a period where you and I, like every central bank in the world these days, are going to want to own gold. Unlike treasuries, which have been essentially infinite in their supply, gold is driven by changes in demand as the increase in supply each year is fairly steady. As demand for gold as a reserve asset, whether on national or individual level, increases significantly, the print option is unavailable. The price, well, that will take care of itself. Grant Williams. Get ready, guys. Own your stuff. It's not a trade. If this stuff gets out of hand, you're going to need it to survive. It's not even a trade. It's survival at some point if the markets get messed up in some degree. Now, I'm not predicting that. I'm just saying it's a possibility. We could see very high rates of inflation, and gold, silver, platinum, some of these metals may save your bacon. So own it. Don't think about it as a trade. Think about it as insurance. Think about it as a way to protect your wealth. We've got gold's next historical breakout versus debt. So we've got all this mounting evidence. We've got a paradigm shift breakout line. They're trying to hold it under this, guys. The Federal Reserve, the government, they are trying to hold the move below this line over here. So yes, it's still below it, and it won't be like that for long. Get it while it's available and plentiful. Don't try to buy this stuff when people are all fighting over it. It's going to happen. And if this happens worldwide, you're going to have a whole bunch of money run at this thing if the whole world is involved in it. The 1970s, that was just America. We've got the whole world looking to run at this stuff now. So get ready. Be prepared for it. Don't be a victim of this. I posted this. This is the Regional Banking ETF, KRE. What does this look like, guys? 1, 2, 3, 4, 5, 6, 7. That's an accumulation cylinder of Livermore pattern. Is this going to break to the upside and we have a gigantic lending boom? I don't know. Maybe we go lower and something happens in the markets, they lower interest rates, and then we go berserk in lending. We'll find out in the future, but it's a pretty interesting setup here, which could be considered a Livermore accumulation cylinder. This was my response to this guy posting that this is a breakout to the downside. I disagree with that. It says, I wrote in early August that I thought there were reasons to believe resale supply would start to increase, and we're beginning to see it in the Altos research. So the U.S. housing drought is nearing its end. There are growing signs that the supply of new and resale homes on the market will pick up in 2024, taking some of the steam out of prices. What this is more lending that could potentially come if we can get home buyers into homes with those new loans against new homes. So there is a supply potentially coming in 2024. 2023 was the lack of supply. We've got Jay Hinster here. This is the Sprott Physical Uranium Trust versus the S&P 500. The best sector for the next several years is going to be uranium as we break out of all these different, we're breaking out of bottoming patterns against a bunch of different assets. This one happens to be the S&P 500. Uranium's probably going to outperform massively over the next 18 to 24 months, and that's probably where we're going to have to look for a potential top. That's my guess. So we're probably going to get the next several years if the move was like the mid-2000s. Now, I don't know that for a fact. Let's wait and see. Maybe it lasts longer depending on the market conditions. But that's kind of the best guess of the information that we've got. Copper, stay focused on the long-term view. Patience will be rewarded given structural drivers such as the energy transition and the gradual stabilization of China's property sector, including a new restocking cycle, demand to grow between 3 and 3.5% in 2024. I know a lot of people are looking at copper. They're looking at the short term saying, oh, we could potentially break to the downside. I think that you should be looking at it from the long-term perspective, and that would be viewed as a buying opportunity if that were to occur or happen. We have a lot of demand out there. We have low inventory levels, and I think copper pricing is going to go higher in the longer term. I agree with Holdco markets. We've got U.S. tech stocks, vastly higher valuations than tech stocks in the rest of the world. At this point, you have to believe that U.S. tech will grow at close to 3 times the rate of ROW tech, rest of world, just to break even between the two. Pretty incredible chart and how overvalued U.S. tech stocks are. That is not where I want to be. Now, in 1988, load up to the hills. Load up and ride it. But we are at this very high valuation, and I don't know, guys. Any way you price technology stocks, they're expensive against everything. This is the mineral stock investor. He says, I've compared the entire universe of uranium explorers and developers in February 2007 with today and found that there's a good case to be made that stock valuations are about 4 times lower today than in 2007. The data is noisy, but the trend is clear. So we do have a long way to the upside of a 4x lower in relationship to the spot price at $75 a pound. So we could have uranium go much higher this bull market than last bull market. And again, that's not my projection. I'm just stating what's possible. And we'll see what happens here. He says, is URNJ going to explode to the upside because of these small exploration developer companies that have a long way to go higher? And I hope it explodes higher. I've got a lot of money in URNJ. Here's silver, or this is SIL, which is the mining companies versus silver. Break of the golden wedge, and we have broken the new downtrend. We're at very low levels where silver mining companies are very cheap to silver itself. We've got URNM versus URA, an imminent breakout here, which I think is possible. Give it some time. And that's where I'm going to end it, guys. So that's what we got going on. That's what people are talking about. Don't forget to give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you haven't already. And Everything's looking good from a commodity perspective on a long-term basis. This is the data that supports it all. A lot of different things. We've got valuations. We've got market conditions that Tavi was touching on about gold and silver, about commodities in general. It's all there, guys. Now's the time to get positioned. Just wait. We're in a bull market. Like he likes to say in the reminiscences of a stock operator, we're in a bull market. Sit and wait and accumulate on the dips. So that's what we've got for today, guys. We'll catch you next time. This is Finding Value.